Some more medium-term opinion. We caught up with the brains trust of Credit Suisse earlier today. Here's an excerpt from that conversation, largely positive on the Indian market and on the earnings story for at least the next 1 year or so, though of course concerns remain about global uncertainties and some asset bubbles.
The last 6 months of flows have been, what, $3 billion of net FI flows into India, in line with probably the rest of the region. Having said that, my belief is that we will probably see more than the emerging market flows others would get. I do believe India is the spot where we will see money coming in more than the rest. So yeah, I remain optimistic of the country. Why I remain optimistic is probably, I'm sure, is what you'd be thinking. I think clearly, reforms, if people believe haven't happened, are on its way. I think vis-a-vis the growth story, India remains stronger than the rest. And I think, other destinations probably have, opportunities, but I think the way the government's operating here, I kind of do believe that we will see more.
The other interesting thing is that if you look at the global picture right now, for world over, liquidity is so strong that investors seem to be buying bonds for capital gains and equities for income. So the world has turned upside down. Post-Brexit, we've seen this phenomenal move. Do you think we are building some kind of bubble somewhere in the in asset classes?
So I think post-Brexit, obviously, one of the things which we have seen, interest rates have come down sharply and bonds have, we've seen that happen. I think the fear of Brexit, the initial knee-jerk reaction happened. I don't think we have absorbed all the impact of Brexit. So I think to an extent, possibly globally, is there a worry we should still be worried about? I think I do believe I would still be worried about global asset prices and the global scenario. I think India hopefully should be shielded from that to a great extent. I think being a standalone consumer-oriented market ourselves. But yes, netted I would say there would be a bit of a worry.
Well, Neelkan, just to extend that point, it's not just valuation versus liquidity. The IMF yesterday downgraded, or day before yesterday, downgraded growth of all economies, global economy as well as US economy, European economy, Indian economy. And yet you are having, this equity market climb. And to be fair, on the other side, you've also had good bank earnings in the US, signifying that something is right in the economic recovery as well. Which will pull and go ahead? Will the growth slowdown prevail ultimately, or maybe in the near term itself?
No, I do think that, that there should be a growth slowdown. I mean, there will be a growth slowdown. I mean, all the signs are that the uncertainty triggered by Brexit is already resulting in people holding off on investments and so on and so forth. There is a lot of uncertainty. The thing that I know from looking at the markets over the last decade is that the failure will come at points that we are not expecting them to, right? So we are watching CDS spreads of banks. We are watching sovereign yields. We are looking at all the things that we have, emerging market currencies. But I think the shock will perhaps come from somewhere else.
So, Neelkan, how should one approach the market right now? Because it's now trading above median valuations. 70 to 80% index stocks are trading above median valuations. Do you now seek the comfort of stocks where the growth hasn't been there, but there is at least valuation comfort, or do you stay invested in some of these outperformers? That's the catch-22 situation right now.
So, so in terms of PE multiples, we are not just above median valuations. We have been higher than this only 4% of the time in our history, right? So we are talking about very, very high multiples. But on a relative basis, we are actually quite okay. So if you look at the earnings yield gap of India versus the 10-year US bond yield, it's still at 4%. It's been higher than that only in stress points, right? So I think that on a global asset class, I don't think we need to worry too much about absolute valuations per se. Our preference has been for being into stocks that have good earnings growth visibility. And that means, unfortunately, still some of the high PE stocks. We have, in the last 3-4 months, upgraded some metal names. We have pushed very hard on some utilities because the valuations are low. And I think after the 14% underperformance of the last 3 months, maybe there can be select IT stocks which actually can give you good trading returns.
Okay, that's the word coming in over there from Neelkan Mishra. But let's look at some